All right, I'm Michael Hartzman, and today is Tuesday, April 28th, 2026. Welcome to the Lebenthal Report, and I'm on this time with my partner. Missed a couple of weeks, but I'm back with Dominic Tavella. How are you, Dom?
I'm pretty good. A little hurt that, as always, with my partner, but I guess not as always, Mike. So I'm glad to be back here with you.
Yes, back to have you in a seat. It's not the normal seat, but I'm happy to have you in a seat doing the show as we normally do. Um, So yeah, let's just hop into it. I mean, sound like a broken record. This war is dragging on. The Iranians have proven to be a little bit more stubborn, and I think the administration thought they would be. And the market, I don't know if it's gotten used to what's going on. The markets are pretty resilient. The economy is pretty resilient, but we'll just get right into the numbers through the first 3 weeks of April, the second quarter. The quarter has been pretty strong. The S&P through Friday was up 9.81%. The Dow was up 6.3, and the Nasdaq, Dom, for the month is up about 15%. So, the AI trade, technology trade is back in fashion, but I don't know. There's a lot of cross currents right now, and it's really difficult, I think, to really kind of get a handle on which way the winds are blowing, or maybe it's just blowing in all different directions. I don't know. What do you think?
Well, let's start with Mike. Right to your numbers, that those numbers are coming off of the end of March, right? And if we think about it, the end of March was pretty much the lows, give or take a little bit, give or take a little bit, a couple of days, but pretty much the lows for the year on the S&P, the Dow, the Nasdaq, with pretty much all three indices down from their highs of about 10%. So what we've seen uh, this month particularly is recapturing those lows, right? Recapturing the highs, and some of the major indices making new highs. So yeah, that, considering all the noise going around the world, to get back all our gains for the year and be a little bit ahead, that's pretty amazing. And to your second point, amazing given that I don't know how much the situation has really improved. And you look at this past weekend with the Iranians basically refusing to meet with the Trump administration in Pakistan, and then throw in the attempted assassination on Trump. Historically, markets do not react to those kind of events very well. And so far, it's always been like blah. Nobody seems to care. The markets don't seem to care. So maybe we've just gotten used to the noise. Maybe the economic impact hasn't been all that dramatic so far. Maybe the markets are looking at the glass being half full instead of half empty. But it's a little surprising. We're kind of flattish, considering the noise.
Yeah, and look, I think the assassination attempt, while unfortunate and tragic, and thank God no one got hurt, I do think that's kind of a one-off, and it happened on the weekend. So, but I am more surprised, and I don't want to use the word quagmire yet, but this thing could be turning into just this long, protracted, debacle that the administration did not anticipate at all. Um, and the market has basically shrugged it off, except for oil. Right? We have to talk about the price of oil, and I think that's part of the disconnect why the economy is rebounding. Because Tom, last April, the price of oil on April 24th last year was $63.55. Last Friday, this past April 24th, an oil WTI was $96.76. A gallon of gas, the average gallon of gas a year ago was $3.14, and last Friday was $4.04. That's an enormous jump for the average American. And here's what's really interesting. On December 31st of last year, New Year's Eve, the average price of oil, Dominic, was $2.81. So oil has jumped, I'm sorry, gasoline has jumped from 281 a gallon just 4 months ago to 404 now. That's some sticker shock.
Yeah, Mike, if you look at retail sales, shockingly they went up, but when you figure out what component of that was actually the increase in cost in gasoline and energy overall, a big component in the increase in retail sales, which normally is a positive. We look at that number and go, wow, consumers are spending, they're feeling confident about the economy, they're confident about their employment situation. But in this case, a big component, not entirely, not the entire number, but a big component of that increase was the increase in fuel prices. And Mike, we hear it every day. Clients are upset. They're unhappy with the circumstances. I think there is a mindset that, okay, sooner or later these prices will start to come down. But the longer this drags on, the more danger we have, both in consumer confidence and then obviously the overall ability for the economy to grow.
Yeah, and look, and we're heading pretty quickly into peak driving season, right? And it's not only peak driving season, Dom. It's the cost of jet fuel. It's the
Look
cost
at
of
cost
fueling
of
heavy equipment.
Airline seats are a big component of inflation, and prices have gone through the roof. I mean, we just recently looked at some prices going to Europe, and it's insane. Those tickets are untouchable in my perspective. So it will ultimately, hopefully, it rolls over, Mike. Hopefully, they come to some kind of settlement here. Having said that, it will start to be a drag on economic growth.
Yeah, and I've said it to you when we did the show 3 weeks ago, and I said it to Andrew, who sat in for you quite capably the last 2 weeks. The Straits of Hormuz were never completely shut down, ever, right? They were blockades, but they know that the Iranians never used that option in any other conflict, and they did this time. And I just think the administration just did not anticipate that happening with 20% of the world's fuel going. And look, I think most people either never heard of the Straits of Hormuz or couldn't find it on a map, right? But 20% of the world's oil flows through it. And I don't think the administration anticipated the Iranians closing it. And certainly don't think they anticipated it still being basically shut down a month later.
Yeah, so part of our call this morning, Mike, and this is a great subject I want to address with our guest, Bill Blancato. But okay, let's make believe that tomorrow everybody's singing Kumbaya and now the straits are open. How much infrastructure has been damaged or destroyed in the Middle East, whether it's the Iranian ability to produce, whether it's the Saudis who've had the Kuwait, Qatar, all UAE, all have had significant amount of infrastructure damaged or destroyed. Let's throw in a curveball. You got Ukraine, that the way they get back to Russia, get even with them, is to damage their energy infrastructure. How long is it going to take before this infrastructure gets rebuilt? And I definitely could see energy prices coming down, hopefully sooner rather than later. But back to the numbers you were talking about, Mike, I don't see that for a long time.
Yeah, and we always try to avoid politics, Dominic, but the Republicans got to get this resolved by the 4th of July, in my opinion. Because again, with peak driving season, people always vote with their wallets more often than not, and I think the Republicans, particularly in the House and the Senate, are going to go to Trump and say, you got to get this resolved.
Well, the question, what does resolve mean,
right,
Mike? So do I think, and look, the Iranians are hurting themselves, right? So that there's no issue. It's not just about us. It's not just about the world. They have significant economic issues as they can't get the oil out, their own oil out. They can't get reimbursed for the expense. They're looking at shuttering their own oil and gas fields. So they're hurting as well. The question is, who's going to give in to the pain first? Will it be the Iranian regime, or will it be, I'll say, the U.S. Administration? But I hate to say it out loud, Mike. I think the Iranian administration doesn't quite care about its own people as much. But who gives in first is going to be the million-dollar question here, Mike.
Yeah, I agree with both of those statements. So you alluded to it a few minutes ago. Phil Blancato at FOP, a friend of the podcast, a returning guest. Um, Phil, as you know, has a great responsibility. He's the chief market strategist of Osaic, which is one of the largest independent broker dealers out there. There are, I don't know. I don't know. You probably know better than me how many advisors work at Osaic, but it's a lot. And they count on Phil for his opinion and his advice. And as I say, he's a great friend of ours, great friend of yours, especially. And we're happy to have him this evening. And we will be right back with Phil Blancato, Chief Market Strategist at Osaic. All right, I'm Michael Hartzman back with my partner Dominic Tavella on the Lebenthal Report, along with our guest this evening, Phil Blancato, Chief Market Strategist at Osaic. Good evening, Phil. How are you?
How you guys doing?
We're doing well. We're doing
Doing
well.
great, Phil. Happy to have you on board.
Nice to be here. It's been a little while.
It has been too long. So, Phil, I know you heard our open, and just to be clear, it's not that Dominic and I are pessimistic. We just see all these different cross currents with the economy. I'm going to just say it, and I think you're going to disagree. Is the market whistling through the graveyard, and are there things to worry about, or has the economy just been super resilient and kind of shrugging off what's happening in the Middle East?
I mean, you got a lot to unpack there. Depends on which angle you take it. Let's just start with some broad-based macro themes. Today, U.S. unemployment is at 4.3%, the second best number of your lifetime. We grew up at 6. Inflation, arguably somewhere between 2.8 and 3.3. It's really more like 2.8 because core inflation much more relevant to the price of gasoline or oil. Think in the context of oil. It's very important. The average person in the United States today uses 7% less oil and gas than they did in 1980. So the impact of gasoline is not really as relevant, I think, as the media has made it out to be. So it's almost irrelevant at a time when the average consumer got between $600 and $2,000 in a tax break. And the reality is the people who drive the most, people who drive are those who make more than $250,000 a year. And in the metrics, the average person who drives uses 2,000 gallons of gasoline a year makes on average $250,000 or better. The person who uses 400 gallons of gasoline a year makes generally less than 100,000. So the impact of gasoline has been somewhat irrelevant. Just look at consumer sentiment, which came out today, which is a very positive number after a bad number the other day. But to answer your question, from a macroeconomic standpoint, unemployment, it's really quite strong. Wages above the rate of inflation 8 out of the last 10 years. And in fact, tomorrow we'll get some data around what we call ECI, Employee Cost Index. We expect that continuation of wages being above the rate of inflation. In fact, here's a fun one for you, Mike. Why I take a different side than most folks. If you look at the number of new businesses started in 2025, it was the most ever. You look at the number in 2026, it's already surpassed that number of 25 based on the same time period. And you look at the people who are starting them, you're looking at youth unemployment between 18 to 25. It's accelerating downward, meaning a lot of those kids are going to work in new businesses. So these are not signs that suggest that there's a headwind from economics. You don't have a heavy inflation anymore. You have to pay more for certain things, and they're never going back to where they were. But with wages consistently above the rate of inflation, think of what an average McDonald's worker makes today in New Jersey, $19 an hour to start. An average Amazon worker makes $28 to start. Certainly, we have to pay more for certain things than we did a few years back, but they're making more. So if an economy is based 70% on its consumer, and the consumer is, I would argue, in excellent shape, you look at the wealth of the country divided by our liabilities, the debt, it's the lowest number in your lifetime. You look at people between the age of 15 to 54, the core of the American workforce, it's over 83%, you know, the highest number of your lifetime. Yeah, there's a headwind here or there about maybe some higher prices, maybe gasoline a bit higher. By the way, prices today are no different than they were 3 years ago and 2 years ago. Different than a year ago, certainly, but you know, the unexpected spike in it's a little painful. But you're not in heating season, you're not in cooling season, you're not in driving season. You're coming up on it. You know, if oil went to 120 or 130 a barrel, 120 or greater for 3 months, then you're probably talking a profound impact on the economy that could perhaps put some pressure on the labor market and the consumer to a degree. So yeah, there's this anticipation of the worst is yet to come, but we haven't seen that price yet at all, even in the midst of the conflict. So it's unlikely to get there. And I guess when I look at the healthy U.S. economy, my point is when your consumer is strong, in fact, you look at the last retail sales number, there was a price impact by gasoline, but the other 9 components of the index, every single one of them was up. And while the spending on gas was higher, all other 9 were much higher than expected. You beat the expected number by a full 1%. You have a scenario where just look at manufacturing. For the first time in a decade, U.S. manufacturing was up in January, February, and March. Productivity for the fourth quarter of last year was the highest in any quarter in the last decade. You look at American productivity, it's on pace to be higher than it's ever been. So you got to take that bigger elephant in the room and start there and know that you got to kind of, these punches come from a higher price of oil or a higher price of gas, but generally they're temporary, especially when the consumer is as strong as it is. So I'll stop at one last point. If gasoline and oil were so impactful, why didn't we see a slowdown in airline prices being bought? Delta Airline put out one of their best quarters ever, United right behind them. So even in the face of that, in the month of March, we didn't see any negative headwind. Or go one further. Profit margins on the S&P 500 today are between 11 and 13%. That is double what we grew up with. Double. Think of the hit you'd have to take to really draw down that number. So a temporary price spike in oil and gas, it's a headline, but as of now, it's not meaningful.
So Phil, this is looking backwards. It's hard to argue with your numbers, right? And obviously the major indices, putting today aside for a second, all of them hitting pretty much all-time highs. And earnings growth, you just brought that up. I mean, depending who you listen to, it's 12 to maybe as high as 14%. I mean, we got large cap growth stocks announcing this week. I think the numbers are going to be pretty impressive. But what about tomorrow? And that seems to be both myself and Mike what we're thinking, worrying about. If this thing drags on for a considerable period of time, what's the economic effect? And I'll preface that with one more comment. U.S. versus the rest of the world, we are far less dependent on energy versus the rest of the world because of our own domestic production. So what if this drags out for a really long time?
So let's follow that. That's a great point. The price of a BTU in Germany pre-pandemic, I'm sorry, pre the war, was $10 a BTU. Today it's 20. The price of gasoline in Europe, you were just there, was around $8 a gallon. Now it's 16, depending on where you're buying it, 12 to 16, so double. So when you think about the initial impact today, you take 3.6 million barrels of oil offline in Iran, but to a degree, you're offline in many other countries because they're not sending it out. But don't forget, you have a new supply of almost 4 million barrels now a day from Venezuela and the untold story of Angola. Why UAE backed out of OPEC today is a whole nother interesting paradigm of a breakdown of OPEC Plus is becoming more powerful than OPEC. But to your point, some amount of oil is offline and natural gas is offline. Now, when you think about the United States today, we produce more oil per day than the next two countries combined. It's a neck and neck, which is Russia and Saudi Arabia. So American production is significantly online and producing at a very high rate, to your point, unaffected. Who is affected? Certainly, to a degree, Europe, with a 25 to 50% spike in their prices. Europe has the better part of 4 to 5 weeks left of reserves that they can tap into to moderate prices, and it's obviously going to become an issue for them as things get hot. The bigger issue is Asia. So now here's where the Asians, and by the way, do we care as American consumers about what Europe does to us? Well, we still import stuff from Europe, but they're sixth on the overall food chart of who supplies us stuff, depending on how you look at Europe as a whole and individual countries. Canada, Mexico, and China, the Asia Pacific Rim matter a heck of a lot more to American imports than we do from Europe. So in that sense, if the Asian Pacific Rim, and today China has the largest oil reserves of any country on the planet by a tune of triple the United States. So China's insulated for an extended period of time, and they could become an exporter of the Asian Pacific Rim if they had to be, just to protect their own interests there. So as of now, Asia would be your issue. That import prices would accelerate in the United States, which would be inflationary, which would then hurt the U.S. consumer. And if I followed your thread, if the oil did go back to at 100, I don't think it's incremental enough to matter. I think it's very manageable for the globe because we were there for an extended period of time between 80 and 100 around the pandemic and plus, and it turned out to be a complete non-event. But if we got back there again and we saw it in price, where this thread ends up squarely on the laps of the American consumer is higher import prices, higher oil in the United States to where the cost of fertilizers and the byproduct of oil, not necessarily gasoline, would then spike. And then the Federal Reserve would be somewhat handcuffed to raise interest rates, not lower them. So in a scenario where you raise interest rates, a hike of them, which Kevin Warsh is coming in as the new Fed chair, thank goodness that's been resolved. But certainly a hike in rates, which that probably would have to be September, would mean we'd be in for one heck of a market sell-off in both fixed income and in equity. The irony is that I think that's highly unlikely. And the reason why you have a midterm election coming up, that's very important. The president's appetite to see this come to an end, I think is obviously critically on his mind, along with the negotiations that he has coming up with China, as long as and the follow-on negotiations he has with Europe, tariff related. What I think we're not discounting is that there's 4 scenarios, really 5 scenarios that we study as to what could happen with this conflict. And all 4 of them, and the 5th one is beginning to come in play, but the 4 are a coup. And right now it looks like coup is taking place. That's why the breakdown happened. The military is putting forth leaders that are insisting on being part of the negotiations. A more moderate current regime, which is the most likely scenario, that have to moderate because if they don't, they're out. A full civilian takeover, and that's the least likely. That doesn't seem to be a scenario today. And then a civil war, where other countries come in and try and take parts of Iraq, and that doesn't seem scenario. But the 5th one is the rest of the world has no choice but to get involved. And the reason why is Europe and the Asian Pacific Rim, specifically China, because of the blockade and the follow-on and Iran's desire to get their oil out, Iran's losing $400 million a day. It's unsustainable. And besides their infrastructure being, we think, somewhat impacted, there's not clear guidance on how bad it is or how good it is. But I think sometimes we forget that the largest producer in the Middle East is Saudi Arabia, who's still pumping oil through their pipeline about 30%. But with UAE offline and some of the others, the pressure will only continue to mount here. So I think there's a conclusion that comes before this becomes highly impactful. But to answer your question primarily, which is the real punishment happens in Europe and Asia Pacic Rim, and less so in the United States, because today the ability to produce. Just look at it this way: your home heating bill is up 10 to 15% year over year. It's not because of the war; it's because data center demand, and we use more electricity than we've ever needed before. So that the more interesting scenario is inflation more for the United States. It's less about what's happening in the Middle East and about can we produce more electricity based on the fact we have our own oil and gas? And that's a separate discussion, which is a very fascinating one.
So Phil, you mentioned Kevin Walsh coming in, and I agree with you. Thank goodness that that has been resolved and they dropped the charges, or against Jerome Powell, and now the vote could go through. You mentioned a slight possibility of interest rates going up. My question before we started the show tonight was going to be, with the high price of oil and it being inflationary, will Kevin Walsh kind of succumb to Trump's desire to lower interest rates? I can't imagine the tweeting Trump will do at 2 a.m. if Walsh actually raises interest rates. But do you see interest rate cut coming off the table if things don't change?
Well, if the scenario of oil does spike to 120 or better and stays there for 3 months, you're going to have to hike it. You're going to have no choice. Uh, but that, again, I think that's an unlikely scenario. So to answer your question, Warsh coming in has a different philosophy than, and I actually really like this, than what the Federal Reserve has traditionally done. He's kind of got a third mandate, and the third mandate to me is the most interesting one. It's the management of interest rates. It is certainly the management of unemployment. But with unemployment not an issue right now, and interest rates, I'd argue really not an issue. The front end of the yield curve right now, so we don't get a big spike. PCE on Friday for your listeners is you want to do what I do for a living, just focus on PCE, personal consumption expenditures. It's the only metric that's the leading metric that matters. It measures every single month what we spend on 148 data points and how much they change month over month, and that's the one that matters. But when you get to the core of it for Kevin, his third mandate is the reduction of the Federal Reserve balance sheet. So one of the things you hear a lot about is how the United States has this debt to GDP ratio that's not great. And you think about what Europe is much worse than the United States. You think Japan is. The problem is if you took away the 8 trillion that's at the Federal Reserve and 7 trillion plus, and you took it out of the debt picture, we're really make about 32, 33 trillion a year, and we owe about 34 trillion. So our debt to GDP ratio is not terrible. It's about 5% of our of our total GDP, greater than our GDP. So in that scenario, Kevin's desire to reduce the balance sheet means he pushes liquidity into the banking system. Banks get the cash rather than keep it at the federal government. I think that creates a scenario where the Federal Reserve has a new mandate. And in that new mandate is it's a pro-growth mandate, which we haven't seen that in a long time. If you go back to Milton Friedman economics, if you reduce the money supply, M1, M2, how much money's floating around out there, then generally what you get is moderating inflation and a pro-growth environment. The reason why we increase the money supply is because you're worried about recessions, more money to borrow. You kind of use it to heal a lot of wounds. But if you decrease it by taking away from the federal government and put it in the private sector, or just taking it and giving it back to the Treasury, you have a tighter market. And that's a fascinating scenario. Is the economy ready for less cash floating around to lend out? Or more importantly, is the economy ready for banks to have more cash? And if it works out that they give more money to the banking system, hold on to your hat, guys, because then the economy grows at 3% or better. And to fix our debt problem, you need to grow at 3% or better for 2 or 3 years. Couple that with the part of the big, beautiful bill, which I think is undertold and a fascinating scenario, the fact that you can deduct immediately from your revenue the money you spend on adding to an existing corporation. There's 136 companies that have spent $2 trillion to add new businesses to the United States, and many of these will be highly productive revenue-generating firms. Fascinating experiment. I think we're in the middle of an experiment, and Kevin's part of it. Can you create a pro-growth engine that raises U.S. GDP to 36, 38, 40 trillion, hold your debt where it is, and suddenly you have a scenario where you're no longer in an annual budget deficit, but an annual budget surplus because of growth and not reduction in spending? Wow, that's a fascinating environment. But to answer your question, this year's Black Swan clearly is a hike in interest rates would be destructive to every asset class. If you get a moderation, which I think we do, and the reason why I think we get a moderation is technology deflationary, AI deflationary, demographics deflationary. Over the long term, we're still going to get back to moderating inflation. And the front end of the yield curve today at 3.5%, when inflation's at 2.8, if you strip out energy and food because they're volatile and you should, is still a bit too high. So ultimately, you get a cut, one this year and probably two next year.
All right. Well, that is certainly what I think everyone's expecting from the administration on down. So why don't we take a break right there, Phil, and then we'll come back with Phil Blancato, Chief Market Strategist at Osaic.
Tommy, how's all the grandkids, buddy? How many are you up to now?
Love it. Love the question. Love the answer. 8 and number 9 on the way.
Wow. And you're 1 at 12. I think 12 was your number, right?
Well, this is the one I've always gotten my rear end kicked on because,
All right. Michael Hartzman back with my partner, Dominic Tavella on the Lebenthal Report. And our guest this evening, Phil Blancato, Chief Market Strategist at Osaic. Phil, let me ask you this. You talked earlier about all the job creation that went on last year and again this year. Last week we did a show with the head of the Small Business Administration for the Northeast region. He kind of alluded to the same thing. A lot of new jobs are being created, a lot of new business owners. But every now and again, I'll have a conversation with a client who's worried about the dark side of AI, where a machine can now eliminate the job of a paralegal, the job of a researcher, a job of of like the low level accountant who does the grunt work. You know, as you alluded to before, the person making between 70 and $100,000. So, twofold question. One, do guys like you, when you're sitting around, you know, in a quiet room smoking cigars, worry about this thing? And two, if it's a worry, is there a solution?
You know, it's a very, we could spend the whole rest of our time together talking about it, but I'll give you a pro and a con.
Okay.
So on the pro side today, if you look at Anthropic, which is the most utilized large language model, chat, you know, what you use for AI. And if you ask it 1,500 questions, if you had to guess, Michael, of the 1,500 questions, what percent of them would be wrong? Which would it make up?
35.
How many?
35%.
You're spot on. Good for you. About 32. So if you ask Gronk 3, it's 94%. So in other words, we're not there yet. For all the people that worry about AI dominating and taking away jobs, it's just not there yet. Now, the obvious answer to this is, I'll give you something you will probably use. There are many institutions today that use note takers. We used to have a person in a meeting taking notes. And the person, now you can turn on your phone and turn on something called, you know, Jump or Zot or Gene, whatever. There's all those different versions. They'll record an entire meeting, give you a follow-up plan, and then make sure that you it's in your calendars. That's pretty cool. So you don't need a person to do that anymore. You may not hire a body anymore because there's that person who could do that. But if the notes it took are not really right, someone's still got to review that and put it in there. So we're not quite there eliminating bodies yet. But I would agree that the AI agents, which are now Walmart, are going to have millions of them out there servicing people. And I'm sure many of you have just spoken to one and don't even know it. Today on Spotify, which is probably the most used song app out there, 3 of the songs on the top 50 are fake. Fake singer, fake music, completely fake. So on the top 50 list, it means no songwriter wrote it. It means nobody out there who created the lyrics, and certainly who's making money of it, but some guy person or whatever who created this thing. So that's scary, you know. And you think about that in context, that's a worrisome thing, and I think it's going to accelerate. When Amazon came out and talked about how many of their mid-collar, white-collar jobs they want to eliminate. You look at the average Amazon factory, there's robots zipping back and forth already. Walmart factory is the same thing. And so you're looking at some of the scenarios and you're going, wow, this is happening in living color and probably going to accelerate. And I think that's absolutely right. I'll give you a real example. You and I live on the East Coast together. Next time you go to a Weiss Castle or Jack in a Box, or I think Whataburger now as well, there's the hardest job to fill in a White Castle is the person who fries French fries. It's got 156% turnover, highest call and sick rate, and very difficult to staff. Well, Miso Robots came out with a AI arm. They partnered with NVIDIA, and the arm fries a perfect French fryer. It's called Flippy the Fryer. Fries the perfect French fry every single time, and it's in White Castle. And just for fun, how many baskets of French fries do you think my friend Flippy fried last year?
A million.
Man, not even close, buddy. Almost 5 million baskets, 200,000 man hours. That arm didn't pay benefits, didn't pay taxes, didn't call in sick, and fried a perfect French fry every single time. So wow, this is happening, and it's going to accelerate. In industries that are, especially in the first rung of the labor force, whether it's washing dishes, the second hardest job to fill, and with a lack of immigration today, I think one of the things the administration has to figure out, and I don't play politics, I really don't care. I don't care left or right. My job is to make money best based on what Washington does. But demographics matter. And when you don't have new people coming into the workforce, you got to find robots to replace them. And one of them is a dishwasher. And now there's a dishwasher that can wash dishes. Heck, I just saw one the other day that ping pong. It's amazing at ping pong, believe it or not. So you have these scenarios where things are being disrupted. So that's absolutely true. And I do think the first rung of the workforce is a bit in jeopardy. So let's compare this in context over history. In 1970, 43% of the American workforce was in the first rung, when a lot of these jobs got sent somewhere else in the world. Today, 23% are in the first rung. That number is probably going to 15. So those jobs, those first menial jobs, are going to be eliminated. But what happens to back to where I started before, if we're starting all these new businesses, hold on, wait a minute. AI helps you what? Create a website, do your accounting, not need as many people, get a business off the ground, all the infrastructure that you need, all done in the blink of an eye. So the essence of capitalism, whether you're Jeff Bezos or Bill Gates or you guys who have your own business, is this ability to just have an engine that creates new businesses on a regular basis. By the way, we're closing a lot of them too because some of them just don't work. But in a world where you get lower interest rates because of productivity and the ability to start new businesses really fast, hang on. You've got a whole new industry that's created in the application of AI, the governance of AI, the compliance of the data, the output to make sure it's clean. Is it harmful or not? The healthcare industry today, which is short people still, and whether it's a robot that's going to take you out of bed, feed you, wash you, bathe you, and talk to you all day long because we don't have bodies for those jobs. So there's a new industry that's going to be created along the way. And let's not forget power. We need to increase the size of our power grid by about 25% in the next 10 years. Otherwise, we won't meet our power demand. So on one hand, yes, there's an issue with some jobs, frying French fries going away. On the other hand, there's new industries that should be created, and some of this just can't be done with AI. Are you going to hang up? No, there's no robot yet that can hang a new line and drop a telephone pole on the ground, or better yet, manage a modular nuclear reactor. Are we going to need skills training? Sure, and AI might do that, by the way. Are you going to use your phone to probably do what today's doctors have to go in person for? Yeah, absolutely. I mean, that industry. So this industrial revolution we're in, there's plenty of unknowns. And as I mentioned before, we could talk for a long time about it. But there's also lots of examples of the ability to bring technology that's going to change our lives dramatically. And just for fun, for everybody's listening, just go into ChatGPT, the free version, and say, I want to go visit Mike Hartzman from where I live in we'll make it up, Kentucky, and I'm going to drive to Long Island. What stops should I visit along the way? And watch it give you a printed itinerary, what roads to take, what's cool to see, and it's all free and in a blink of an eye. In the same way, Google Maps, I would argue, is the greatest invention of our lifetime still. And the efficiencies it brought to us, I think it's the same kind of thing, at least for now. Long term, let's just see. I do think there's a lot to be concerned about, and certainly there's a lot to be excited about. But in its infancy, I think it's exciting. From an investment theme, look at what large cap growth has done. Today we have got greater than $1 trillion companies in the United States. There's nowhere else in the world that's a $1 trillion company. Not Europe, for especially. Not even half trillion. So in that sense, wow, has it catapulted the United States way into pole position. And by the way, all the ancillary companies, like for fun, Mike, I'm gonna have to play a little game with you. You're gonna get this right. I know you will. What's that white pot you have in your house that has pretty little flowers on the side, and it's a cookware that you've used your whole life?
Corningware.
What else does Corning make? Two other things that are fundamentally impactful to your life.
Fiber optics.
Yeah.
Fiber optics.
Copper
Spot
fiber.
on.
Yeah.
What's the number one fiber optic company in the world today? Corning. Why?
Yeah.
Because they're in data centers. So the movement of AI has boosted Corning to an all-time high, and they employ a whole bunch of people. So there's more to this story than just losing the guy frying French fries. It's the impact and growth of AI and where it puts the United States in pole position for not just software companies, but for a lot of different companies.
It's a great answer. Thank you, Phil.
So Phil, I'm trying to think of which question to go with next, but let's talk about these large cap growth stocks. So Magnificent Seven year to date, pretty much zero return, right? Maybe plus 1 or 2%. But small caps and mid caps have just crushed it. Why have the Magnificent Seven underperformed year to date? Why have small caps and mid caps done so well? What do you think happens going forward?
Fascinating first quarter. Look at some of the points. At the end of the first quarter, the S&P weighted was down 4.3%. Equally, it was flat. In fact, up a little bit, depending on what day. On the very last day of the quarter, I think it ended up down 0.03. So in other words, the rest of the market, to your point, Dominic, has crushed it. Small caps now up 12% on the year. Equally weighted, still up 6, but the S&P went from -4 to now +5. And while the Magnificent Seven were at one point down 13%, to your point, basically now flat, NVIDIA did just hit an all-time high. So what happened with the Mag 7 was that it's a little bit like going to a grocery store, and your most expensive thing on the store is all you bought for years. And you kind of get sick of buying it because it's just too expensive now. So you start looking, what else can I buy that I'll eat that's cheaper? and that would be your mid caps and your small caps. So they're traded at a 25% discount to the S&P, and they were a much better value, and they still are. But there's a few other things that mattered. In the same way, Corning represents the rest of the economy now benefiting from AI productivity and revenue. That's what's happening in mid and small. They're part of the AI supply chain, not all of them, but many of them. They're part of the infrastructure build we need, and that is mid and small. Then you lowered interest rates, which are a boost to their earnings. And then you go one further and see they're trading at a discount. Boom, we've got success. And by the way, very indicative of the US consumer because 82% of the American workforce is employed by companies who have less than 250 people in them. So if you're in a small cap company, which you probably are, and you haven't lost your job, and you got a wage increase, and your company's doing okay because of lower interest rates, and maybe you're involved in the AI story, be more efficient or just being a part of it. Holy smokes, this represents a great opportunity for the first time, really, since 2008, because we could all laugh at each other and go, we believe in diversification. We think bonds matter. We think small, mid, and international matter, but they really haven't mattered a hell of a lot. And at least the last 10 years. And why do they matter now? Because AI has changed the way we live and work already. But those stocks got so expensive and these other companies started to look really reasonable that they've now finally started to look like they've had over the last century. And the reality is small caps have been the number one performer for the last 100 years. And finally, they're showing you why. More volatility. While they were up the most year to date through the end of March, they sold off the most in that correction at one point, and now we're up the most again. Even though they sold off a bunch, they were still up for the year, and they never were down. But what's exciting about this story, Dominic, is I just think you have a return to normalcy. Now, that might sound goofy, right? But normal means normal stock market S&P 500 returns of maybe 8 to 10%. Normal small cap returns of something greater with volatility, 12 to 16%. International won last year by a lot, not just because of the dollar. A lot of it had to do with the dollar, but because we're getting earnings growth in Europe. They're spending money on defense again, and that's mattering to their earnings. So there are other areas of the world as AI has got to a point where it's hit its ceiling, and they're still growing pretty well, but not to justify these incredible returns. So other areas of the marketplace suddenly look a lot more attractive, which means, guess what? A balanced account is the winner on the year, even with bonds only giving you 1%. So diversification matters. You lost less in the correction. You were down probably a fraction of the S&P, and you're probably still beating it or darn close to beating it on the year.
So to that point, well, all three of us are old enough to remember the bear market of 2022. And if we recall, Phil, the concept of 60-40 was dead because for that 1 year, which was kind of a one-off, stocks and bonds both disconnected and nothing was working. But what I'm hearing you say is 60-40 is not dead.
Not right now, not at least in equities.
Mm-hmm.
The bond market the bond market was a great place to be for 40 years.
Mm-hmm.
And then it's acted like, to some degree, not completely, to some degree, insurance for the last 10. And last year we had a great year in bonds. But remember, we got our butt kicked in 2023, down 13, almost 14%. And it's because we're not getting the yields we once were on bonds. But I would argue bonds are sexy again. That's my fun phrase, because you can get a yield of a bond portfolio that's still greater than the rate of inflation. So the 60-40 is relevant again. Bonds are relevant again. Maybe not as relevant as they once were. I love that 8% we got last year. But certainly, I think 60-40 is relevant because you got a diversified equity portfolio is the winner again. You actually have less risk by being diversified and more return. We haven't been able to say that in a while. And then the bond portion of the portfolio is doing its job. Even in the midst of the correction, not down nearly as much as the S&P 500, almost up 1% on the year. If you take 4 quarters times 1, that's 4% on bonds. That's okay. That's not a great number, but beating inflation and act as to some degree an insurance policy. Unless rates go higher, then you're gonna get. That's not going to be great for bonds, but I don't anticipate that.
So, Phil, one of our favorites, Rick Reeder, just loves the bond environment right now. He just thinks it's downright giddy that he can get these kind of yields, and they might tick a little bit higher, as you pointed out. But I think longer run, they come back down. You want to talk about what a great buy bonds are right now?
I mean, my bonds are sexy again. I give you one further. Municipal bonds are even more sexy. And the reason why, I live in New Jersey, and New Jersey is a flawed state with ridiculous taxes. We're the second highest tax state in the country. If you're a New Yorker, you're probably right behind me. You are right behind me. And there are yield municipal bonds you can buy in the state of New Jersey that are going to mature in 30 years, but they're probably only going to mature in 10 because of the way they work. It's a long story. But you can get a yield around 4%. And there's really no risk in the muni bond market. I'd argue municipal bond defaults is kind of a unicorn. They don't really exist. I mean, they've happened for a blink of an eye in history. You look at default rates at munis, it's minuscule. But if I can get a 4% yield out of a bond in New Jersey, and I live there and I pay taxes at the state level, the local level, and the federal level through the nose, my real yield is probably closer to 7, maybe 6.5, because I don't pay any tax on that. That's that equivalent taxable bond would have to yield 6.5 to be the same. So let me get this straight. I can buy a bond with basically no risk and get a risk-free rate of return that's equal to, call it 7%, just to make it easy, for 10 years. Oh my God, just go buy those and go to the beach and forget about this podcast because it's irrelevant. Clip your coupon and call it a day. So I think I agree with Rick. I think it's a great place to be. I would like to see bonds act a little bit more like a safe haven. What we do see as on risk-off moments, yields go higher and the equities go lower. It didn't used to work that way. And the reason why it does is because of the size of our debt. At the end of the day, we are in Dante's Inferno. We're on level 1 of Dante's Inferno. If we don't get our debt right soon, we're going to start to look like Europe and the rest of the world. Where, think of this, how terrible this is. For every $5 we earn in income as a country, we spend $1 today on interest payments. $1. So that's to Rick's point, bonds are great because they give you a wonderful yield. I just don't know how much interest rates are going to go down on the 10-year. I could see them settling in. Today they're at 4.3%. They may come down to 3.75, maybe, probably more like 3.9. So you'll get the way bonds work is prices go higher as yields go lower. So we'll get some of that over the next few years. It's really more about the income. I'm just a bit disappointed because of the size of our debt, yields are stuck higher. And when markets get worried, then bonds actually sell off, not get bought. And that's unusual. That's not the way we grew up. And it's because of the size of our debt.
So Phil, you mentioned AI note takers, and we do use an AI note taker for this show, and it always gives us the highlights. And I can't wait to read it tomorrow. Phil Blancato discusses Bonds is Sexy Again and the 7 Rings of Hell. So we knew we had to have you back for a reason, Phil. Thank you.
My pleasure. It's an honor to be on your show. And it was great. You're both incredible guys, and to be here is a lot of fun for me. Thank you.
Thank you. So look, we got 3 minutes.
Positive attitude you bring to the whole thing, Phil. Obviously, you manage quite a large bucket of resources. So I know you're always looking at the picture in a very honest way, but being optimistic helps the situation.
My pleasure. Maybe I'm too optimistic. Maybe I should start whistling more, or whistling less, I should say. Thank you
look,
very much.
not at all.
If you're a French fry turner, you're in trouble, Phil. That's what I got.
That's a good point. Well, thank you for having me on. It's an honor and a pleasure. Seriously.
No, we look, we're going to impose upon you a couple more times in the future. You know that, Phil. We always appreciate your time. We know you're busy, and thank you for coming on tonight.
My pleasure. Have a great night, guys. Bye-bye.
Thanks, Phil.
You're welcome. And Dom and I will be back next week with a new edition of the Lebenthal Report. Have a good night, everybody.